going. Hi, I'm Mike Sadler. I recognize a lot of you from previous sessions, whether that was live or just your Zoom face. I can't remember exactly, but thank you for having me here again. I'd like to thank Larry and Helen Mary for once again inviting me back. I think this is fourth or fifth time I've done this. Can't remember exactly, but and I have to admit that it's a little bit harder to know what to talk about this time because we are in a weird situation, with the economy. We don't necessarily understand where it's going or what's going on anymore. This was part of the theme, I believe, last year as well, because I think we brought up the point last year that the recession that was supposed to come that never did, it was the most predicted recession in history because we get forecasts from a group called the Society of Professional Forecasters, and the probability of a recession coming within the next 6 months or whatever it is that they asked them was higher than it had ever been. And then here we are. We just got our new GDP numbers this morning, 3.3% real GDP growth, following on from almost Chinese-like numbers last time, like 5.9% or something like that. I mean, the economy is growing and it seems to be very strong in many ways. And labor markets continue to be very tight and people are happy with their jobs. I just read something this morning about, I believe it's the Conference Board surveys workers all over the country, just like they do consumers, and ask them about consumer confidence, how optimistic you are about the future. They do that with businesses. They do that with households. This was one I wasn't familiar with, and it's a survey of workers, and it was something like 67% of workers said they were happy with their work situation now, and that's higher than it's ever been. So obviously things are looking pretty decent, despite the fact that we can't get everybody on board to that message. And so the way I was going to start, and again, as with previous sessions that I've done here, I'm willing to really give a try to just about anything if you've got questions. Okay. I had a tough time deciding what topics to put in this time because there's not that much to talk about. And a lot of what we have to talk about is disappointing in the sense that we don't necessarily have any real way of understanding where the economy is going. Macroeconomics is in something of a crisis, and we'll try to get to that. So let's just talk about some of the current trends right now. And I can read this a lot better. And this isn't a complete list, but top amongst them has to be what's going on in China. There's been slowdown. They've had the deflationary impulses. Deflation, is a sign that your economy is sick. It's about pretty much the worst thing. That hyperinflation or deflation are the worst things that you can have happen to your economy. And that's what they're suffering in China right now, right? So far, we don't see much of an effect here. Your industry might. I'm not sure about that. I don't know how much of your equipment is procured from China. But there might be repercussions from that down the line. But certainly, we haven't seen much of a impact on Chinese imports. They need to continue to export to us. That's one of the things that keeps their economy going, obviously. And we don't export much either. So it's not like because of a Chinese slowdown, we slow down, which is a phenomenon that happens in all sorts of countries because they're dependent on trade flows. Okay, so we should see prices for certain materials decline. One of the reasons why materials prices have been so high for so long is because of the growth in China and India as well, but mostly from China. And that's been going on 15, maybe up to 20 years by now. But now that the Chinese economy is slowing, right, there won't be as much infrastructure being built. Their housing sector is no longer as dynamic. Materials flows will seek other markets and prices will almost surely go down. That's probably good news because they've been very high for an awful long period of time. We've got a strong dollar. It's weakening as we speak, but not much. Okay, that's bad for our companies that export, right? And so if the dollar is strong, it makes American exports expensive to foreigners. And so we've seen some of that. We've seen it affect certain companies that rely. I know that as an economy, we don't export much, but certain companies obviously depend quite a bit on trade to other countries, and this is affecting their bottom line. But we're not seeing much of an effect of it in other ways. Okay. We have continued turmoil and uncertainty, mostly in the international arena, right? What will Russia do with Ukraine? What's going to happen there? How's that going to affect international energy markets and commodity markets? Okay. China, saber rattling vis-a-vis Taiwan right now, obviously a big worry. Nobody knows where that is headed, but it's getting ugly, as you're probably aware. And then oil prices are still in the news all the time and still could wreak havoc with the economy. Now we've got sort of a game of chicken going on between OPEC Plus, which is the original OPEC, plus the other countries that they added to that are cooperating with them, versus what's going on in the United States. I mean, we're now the largest producer of crude oil in the world by a long ways, too. And we went from producing about 4.5 million barrels a day, about, let's see, how far back do I have to go to get there? 12 years ago, 13 years ago, to now over 13 million barrels a day. Okay, we're now the swing producer for the world. When OPEC cuts their production, unconventional oil companies, meaning frackers in the United States, tend to up their supply, and that keeps the market balanced and has kept the price of oil and gasoline low. That could be disrupted at any point, right? By war, by other types of international turmoil. We'll see. But right now things are looking pretty good, as you probably understand. Okay, the consumer spending remains strong in the U.S., right? Boosted by growth in earnings and a strong labor market, growth in labor earnings in particular, right? Wages and other labor compensation measures have been increasing at a faster rate than we've seen them in quite a while. You probably know, and I think I may have brought it up here before, that if you go back as far as the 1970s up until around the pandemic, right, wages of a typical, what we would call a working class, a blue collar worker, did not keep up with inflation, right? They were their wages, their real wages, right, were basically the same in 2019 as they were in 1973. Okay, and so this has changed, right? There's been more bargaining power by labor. They're enjoying more bargaining power. We see more unionization. That's not necessarily good for everybody, obviously, but the fact that wages are rising at a faster rate as a result of all of this is obviously keeping the economy going. That's the most important thing for understanding spending by households, which is the primary thing that keeps the American economy going, is their labor earnings. And their labor earnings have been increasing at a faster rate than we've seen in decades, right? All good news for the economy overall. We've achieved the proverbial soft landing, it seems like, right? Again, we'll see. But the soft landing is, we went into a period where we had inflation over 9%. Okay, and we're trying to bring that down without causing the hard landing, which means we're going to go into a recession, right? The soft landing means that policy is successful in bringing inflation down without causing a recession. Now, it happened sort of in a more beneficial way to the economy than we've ever seen it before. And we don't necessarily understand why, right? I mean, how long? I'm sure that you've been reading the newspapers too, or you were 6 months, a year ago, when they said, if we're going to bring the inflation rate down from this high level to a more manageable level, the unemployment rate's going to have to go up, right? There was even a very famous Nobel Prize winning economist, Olivier Blanchard, who was dressing down other economists that said that in the media that said that may not have to occur. Maybe it doesn't work like it used to. Maybe we can bring inflation down without increasing unemployment. And he would criticize them in the media and say, oh, they don't know what they're talking about. They don't understand. Blah, blah. Well, it turned out he's the one that looks like he's wrong, right? We have been successful in doing it. Now, obviously, the Fed has taken credit for all of this. However, it may just be dissipation of supply pressures, right? That the Fed can influence demand, right? Which is spending, right? When they raise interest rates to slow down inflation, it's to slow down spending by households. Well, what we call aggregate demand in macroeconomics, right? They don't have control of the supply side, but the supply side can influence inflation as well. It does influence inflation. So what they have power over is the demand side, right? And it doesn't look like most of our high inflation was actually being driven like that. It looks like it was mostly because of supply constraints, supply disruptions, et cetera, et cetera. Those have all come around now. And as they've come around, the inflation rate has dropped because it means that there are fewer shortages in all these different things all over the world. Okay. And so, like I said, the Fed's going to take credit, right, for doing this, but it may be an accident, right? They may not really be that have been that influential in generating the quote unquote soft landing. Certainly they contributed to it. I don't want to make that claim, but it's the result of their, intelligent policy, I think that's probably going a little overboard. I think they got lucky in a certain sense because the supply factors were the primary cause of inflation. Okay. We've had a wobbly banking sector. Okay. It looks like most of those problems may be over, but we're not really sure because they were associated with rising interest rates, and interest rates are no longer rising. Okay. However, we do have a still looming problem with commercial real estate, which could cause problems in the banking sector and therefore in the overall economy. There are a lot of especially regional banks, not the larger banks, that are exposed to the office market. And the office market is in horrible shape compared to what it was before the pandemic. Here in Austin, I don't know if you're aware, but we got the new Meta tower that was just finished just a few months ago. Meta has given up their lease on it. They're not even moving in. They're looking for somebody to sublet. It's an empty tower, and it's the biggest. I think it's the tallest in Austin now. Google built their headquarters, or they're not I guess regional headquarters. I don't think it's their headquarters, but their new building, which is an iconic building on the Austin skyline. It's got a sail shape to it. It's really nice. For 3 years, it sat empty. Nobody moved into it. They started moving people in just a couple of months ago, and it looks like it might have just been to save face because everybody knows the building's been empty for so long. What's going to happen to this? I mean, these are massive pieces of real estate, and we don't need the space anymore because of work from home more than anything else. And that's going to have an impact on the commercial real estate sector because there's so many banks that are dependent on that sector. It's going to have an impact on them. Whether it's going to translate into more of a banking crisis is obviously something that you can't really predict because on the face of it, it doesn't look like it's going to be enough of a hit to bring down the whole banking system unless something goes horribly wrong on top of it. Okay. This is a little bit more esoteric, but the most important single asset market in the entire world is the United States Treasury market. That is the safe asset for the global economy, is U.S. Treasuries. And it has to function in an efficient way in order for it to provide that level of safety that the world depends on. It's not just in the United States, it's all over the world. It's governments, it's pension funds, it's insurance companies, it's banks. They all have to hold safe assets. And there's only one country in the world that produces enough safe assets, and that's the United States, because we're a massive economy and we run massive budget deficits. The world economy is essentially addicted to treasury securities in a way that if we ever actually balance our budget, we may have an issue to deal with then, because there isn't another source of that quantity of safe assets. Japanese government bonds are considered safe. German bunds are considered safe. UK gilts are considered safe, but they don't produce enough to satisfy the demand for all the safe assets in the global economy. Okay, this could be a problem. And now we're having disruptions in that market for various reasons. Liquidity is not what it should be. And we're getting these little micro crises that are causing interest rates to spike on an overnight basis. They're calling into question the credibility of that market. And this is a particular problem because it was in 2019 that we had a very large and unexpected disturbance in the Treasury market, and we got the largest central bank intervention in history in order to deal with it. Those are not things that you want to be doing we're already having central bank interventions because of quantitative easing, the monetary policy that was implemented as a result of the Great Recession, and then doubled down on the pandemic, right? And now they're having to intervene on top of that. In really massive ways. That's a sign that your market's not functioning properly, and that's a worry. Okay, but it's not one that we can really understand all the consequences of at this stage. So the next part of this is just to explain that the United States economy is being described as a juggernaut. As the rest of the world struggles, the United States economy has been just performing better than it has in quite a long time. Okay. And we don't necessarily understand all the reasons why. Okay. But this graph is kind of fuzzy. I'm sorry, because I took it from Matthew Klein's blog because he can do it better than me. And what he's showing is real GDP, right? Going back to the first quarter of 2019, this was the projected trend, right? Then we get this giant pandemic, right? Which means we got a massive recession and things slow down a lot, but we recover back to that trend. And now we're actually above it. We're above where we were predicted to be before the pandemic hit us, with all the devastation that was entailed in that pandemic, which is pretty miraculous. And nobody, again, something nobody saw coming. Remember, we're supposed to be in recession right now, according to most economists, as of a year ago. Okay, none of this is expected. The growth rate that we got today, the growth rate of 5.9, I think it was last quarter, none of that was supposed to be happening. Okay, and it's quite remarkable. Don't ask me to exactly explain it, okay, but it's quite remarkable. So this is growth now. The other one was the level of GDP, right? It was indexed to 100, so if it was a bigger number than 100, it was growing. This is the actual growth rate now. Okay. And so it was 4.9%, not 5.9%, but that's still a 5% growth rate I mean, this is the recovery from the pandemic. We never get growth rates this high in the United States. This was only because we were recovering from the pandemic, and it had fallen so far during the pandemic that this was the, opening back up again, and things are, there's going to be a lot of economic activity. But remember, you're starting from a much lower base then. You're trying to get recovered to be back up where you should be. That's what explains those high growth rates there. This one is almost miraculous in American history. We haven't seen a growth rate like this. I can't remember how many decades we have to go back, right? And then today, 3.3% for Q4, which is also strong, right? Better than anybody, again, expected about a year ago. The unemployment rate, whoops, my box moved on me. The unemployment rate remains at historic lows. This is the longest period of unemployment below 4% in American history now. Okay. Again, who saw that coming a year ago when we were told that we were headed for recession? Get everything into something safe, right? Batten down the hatches. We're headed for one of the worst recessions we've seen in a while. No, we're not. Okay. And so, if we draw this line back, look at that. We got to get all the way back into the 1950s, really, before we see unemployment rates that low, and never for sustained for the period that we've seen them recently. Okay, this is another way of looking at the jobs market. This is unemployment claims. The green part are the initial claims. Those are people who are going into the well the first time. Okay, the red part are the continued claims, people that have been unemployed more than 1 week. Okay, this stuff comes out once a week. It can be a little noisy, so we're taking the 4-week moving average in order to smooth that noise out a little bit. But look at it. I mean, this is incredibly low. Right? There's no sign of stress in American labor markets whatsoever if unemployment claims are still this low. Look at before the pandemic, it's comparable. Okay, and that's the way it looks through history during good times. Okay, so we remain a juggernaut. Yet there are an awful lot of questions still pending. And so I'm going to get to, I figured, everybody, I'm talking about what everybody else is talking about now. If I turn on Bloomberg, all they talk about is interest rates in the Fed, right? When is the Fed going to lower interest rates? As if the Fed had this thing where it controlled all the interest rates in the economy. The Fed has control of a couple of very short-term interest rates. And that's how monetary policy works normally. They control those very short-term rates, like the federal funds rate, which is an overnight rate, right? And they have control over those, but traditionally they set monetary policy by using policy to adjust those rates, and then they would hope, I shouldn't say they'd hope, they would depend on our existing financial theories, which said when short-term rates go up, long-term rates should go up too. Because according to our theories, long-term rates are an average of the short-term rates that are expected to prevail over that horizon. So if short-term rates go up, long-term rates should go up too. Okay, keep that keep that in mind. So I think we've seen this graph before, although it's more up to date. I've shown this in previous sessions here. It's an interesting graph because you don't see very many graphs that look like this in economics or finance. This is the 10-year treasury yield. It's just an interest rate, right? But it's a really liquid instrument. And so this is considered something of a benchmark interest rate. It's the yield on 10-year treasuries. Okay, other interest rates will move in similar ways to this, right? But you don't see very many variables throughout economic history that just have a secular trend upwards like this. Obviously, there's a lot of higher frequency jittering around in there, but the trend is upward, and then a consistent downward trend accompanied by high frequency, jitters up and down, but a continued downward trend all the way until the pandemic. Okay, and now, right, interest rates have started going up again, right? This is, I've been using this graph and showing this character in talks like this for 10 years now, right? And we would come in and somebody would say, oh, look, right, it's going back up again. That means since it went up like that and came down like this must be the start of the next trend upwards like that. And we'd say, well, maybe, right? And then it would go up and then come right back down again, right? And go even lower than it was before, right? Well, we got a little bit of that going on here too, right? It spiked up and then it came right back down again. So whether this is sort of a breakout trajectory and whether we can expect interest rates to be on a more upward trajectory from here is very much an open question. And I don't like to make forecasts, but I would say I think that's unlikely. Okay, there's a reason why interest rates have been lower in more recent times. It's kind of a complicated explanation, but it has something to do with what we call secular stagnation that I think I've actually introduced in a previous talk to this, which says that our market economies now just can't expect to be as dynamic as they were before, as we experienced them historically, that they're growing at slower rates, right? That unless policy is used to stop that, it's going to continue, and there's no real appetite to implement the policies that are necessary in order to do it. So we think the economy is going to grow relatively. If you're a secular stagnationist like Larry Summers, who you may have heard of, and other well-known economists, then your prognostication is that we're going to continue to sort of languish like we were before the pandemic. We're going to grow at slower rates than we're used to, right? The labor market is going to be not as dynamic as it has been historically. That'll result in lower inflation rates and lower interest rates. Okay, and that may be a continued long-run phenomenon from here. So I don't think, and again, don't quote me on this, I don't think this is going to be an upward trajectory at all, right? I don't think it's even going to stay as high as it is right now. I think these are probably coming down. Okay, and that means mortgage rates and other interest rates coming down with them. Okay, now, I'm going to get a little bit more technical. This is sorry about the state of this graph. It's a little embarrassing. I stole it from a textbook and I just scanned it. It's not even like, it's even cockeyed a little bit, but it was easier than me doing it. And so we're going to get a little bit more technical now in ways I've never done in this session, in one of these types of sessions. And if it's too much, just cut me off and tell me to move on to something else. But this is about what determines interest rates. What do we need to know in order to try to understand where interest rates are going? Okay, and the nominal interest rate is just the published interest rate, the one you see on your credit card or published on the marquee in the bank and the real interest rate is the underlying true real rate of return. Okay, that isn't something that historically we can really observe. It was a theoretical concept for most of my training as an economist, right? And then the nominal interest rate itself, right, is the real interest rate, this underlying real rate of return, plus the expected rate of inflation. This is called the Fisher effect. If people expect inflation to be higher, then if you're a lender, you're going to demand higher interest rates because that inflation's eating away the value of your interest. So the Fisher effect says that there's a positive relationship between expected inflation and interest rates. If you think inflation is going to be higher in the future, then you're going to ask for higher interest rates to compensate you for the effects of that. And it's a real phenomenon. And the data shows how how valid a relationship. It's one of the few things that I teach in my macro class is that you can hang your hat on this. This property is always going to be here. Some of these other things that we learn in this class, the economy may work differently in the future than it does now. We're starting to see that happen already, but this one is always going to be here. Okay, and then over here, all they've done is they've broken down the real underlying rate of return into the different sources that make it up. Okay, so let me just go through these briefly, and hopefully we don't have to. We're looking at a government bond with the Treasury, so we don't need to worry too much about risk. It's a safe asset. Okay, the United States government has never defaulted, and barring shenanigans in Congress that actually cause it to happen, it never will. Okay, I should be very careful about saying that nowadays. So we can break down this real interest rate into these four other components. The real risk-free rate is the most fundamental. It's a low rate because there's no compensation for risk there. Okay, and then you've got the risk component, which for a corporate bond would obviously be relevant, but for a treasury is not. For some government bonds of other countries, country risk matters. Right? If you're buying a bond from Russia or Argentina or something like that, it's gonna pay a high interest rate to compensate for the additional risk that they may default on you, because they do on occasion. Taxes. The higher the taxes are, the higher the return that you demand. Okay, and then maturity is the last one. This is the trickier one, and the one that the discussion is going to be based on if this continues past this. Okay, so this is sometimes called duration risk or interest rate risk, the source of risk associated with this. The idea here is a longer term bond exhibits more risk than a shorter term bond. So if I buy a bond that matures in 1 year, only a certain amount of bad stuff, including interest rates going up. Once I buy my bond with an fixed interest rate, if other interest rates go up, my bond is worth less now. Okay, that's called interest rate risk or duration risk. It's going to be greater the longer the maturity of the bond. Okay. So, yes, exactly. Well, so you know this stuff already. It's supposed to be. So, and there's two ways of answering that, but you're absolutely right. Okay. So if I buy a 1 year bond, interest rates are only going to increase so much within 1 year. And so the interest rate or duration risk is relatively low. I don't have to be compensated with additional yield so much. If I buy a 10-year bond, lots of things can happen to change interest rates and reduce the value of my bond over those 10 years. Right. And since it's such a longer horizon, it's more probable that that's going to happen. And so I'm going to have to be compensated for that increased risk with a higher yield. That's the typical way it works. So, and then of course, we've still got our expected inflation. So I'm going to show you now some actual data. We're mostly interested in the recent parts of that data that go through all of these. So you can see the components of what determines interest rates, and then you can see what's made them change over time, and also start to make maybe prognostications about where this is going in the future. Okay, so this is the real, so I should have changed the title to not be so technical, excuse me. It's just the real interest rate, risk-free. Remember I said that was the first thing we were gonna look at. I told you this would get a little technical. It's this thing right here, okay? And so here it is. When I was a graduate student, we didn't have measures of this. This is now, you see this TIPS? It's because the government introduced inflation indexed treasury bonds in about 20 years ago that we're able to calculate this now. So we can get a number, because that's a measure. A TIPS pays you the real interest rate instead of a typical treasury, which pays you the nominal interest rate. Okay, so this is a measure of the real 10-year risk-free yield, because the 10-year is a risk-free interest rate. When I was in graduate school, we were always told we don't have any we don't have any way to observe that. It's about 2%, and we just plug in 2% into everything with I mean, no precision to that whatsoever. Then we started to get data back in 2003, and lo and behold, 2% seemed like a pretty good guess. Okay, but since then, since the Great Recession, since the aftermath, since the period of quantitative easing by the Fed, emergency monetary policy being implemented all the way through here, and then doubled down on during the pandemic, right? That yield has come way down. It's even gone negative, which makes no sense, right? If you think about it, right? Then I'm going to put money into something, and in inflation adjusted terms, I'm going to get less out when it matures. Okay. And so nowadays, as you can see, that real yield has shot up. Okay. If you buy tips nowadays, you earn a decent yield off of them. Okay. Which wasn't the case way back here. So it shot up, right? We've got it now at a 1.8%. It went as high as about 2.3% at one point. Okay, that's all great news if you're an investor in fixed income instruments. Not so good if you're in stocks, right? Because higher interest rates mean you're going to be discounting at a higher rate and the value goes down. Okay, but this is that first component, right? It's way up higher than it's been in years, right? It's normalizing is the way we would say this in macroeconomics. At least we think it is. Okay, the second one is expected inflation. That was at the top of the diagram. Now, I know this doesn't say, it says expected inflation there. The 10-year break-even inflation rate is the difference between a 10-year treasury yield and a 10-year TIPS yield. That gives you a measure of expected inflation in the market. It's not perfect. It doesn't tell you what the market thinks inflation is going to be next year or the year after or the year after. It tells you over the next 10 years, using the 10-year version, over the next 10 years, inflation is going to average this per year. Okay, so it's telling us on the 23rd of January, 2024, when I drew this graph, it was the most recent data anyway, it was telling us that the market was anticipating a 2.29% inflation rate to prevail on average over the next 10 years. That's what it's telling us. Okay. But for our purposes, expected inflation has gone way up. That makes interest rates go up. So two of the components we've looked at, the real risk-free yield and the expected inflation rate, have gone up fairly dramatically. And those are causing that nominal yield to go up. Now, here's the term premium. Okay. This is the compensation for additional risk from holding the longer term bond. Okay, the 10-year term premium is telling you how much additional yield do I have to earn from holding that 10-year bond as opposed to a 90-day bond. Okay, and so this is the compensation that you're supposed to earn for bearing that additional risk of holding the long-term bond I was telling you about. And back in the old days, it functioned, it was a positive number, as it should be, right? And the term premium went negative for a while. So now you're getting extra compensation for holding a short-term bond instead of a long-term bond. It makes no sense, right? And the explanations that you'll hear people say is, oh, it's more uncertain now than it is in the future. Like that's the only way that can happen. And everybody throws up their hands and says, how can that be? Right. So we don't know exactly. There are candidate explanations, but we don't know why this thing has gone negative. Right. But it's still essentially zero. Okay. You're not getting any additional compensation for holding a longer term bond than a shorter term bond. Okay. Which is not normal, as you can see from looking at the historical data. Okay. And that's a mystery. And when that's going to, it's obviously started to recover, but once it recovered, it just sort of started to hover around zero. Right. And we've never seen anything like that as long as we've got data. So put some of the pieces together now. This is the 10-year treasury yield, and you could substitute almost any other risk-free interest rate here. If we put a corporate bond in instead, then we're going to have a credit risk component to all of this. So here we are back in the 1990s, right? The Goldilocks economy, as we now refer to it. Right? Things were running fairly normally. Now, it wasn't like during the 1990s, the 10-year yield was 7% the whole time. I've just picked a candidate. It was 7% for a while. Okay. And how did we get there? Well, there was a 2% term premium. We saw that on the previous slide. If you go back to the 1990s, it's hovering around 2%. Expected inflation was about 3%. Fed was not targeting a 2% inflation rate that far back. Right. Nowadays, the Fed targets a 2% inflation rate. That allows us to set our expectations. They weren't doing that back then. So the expected inflation rate was measured at about 3%, and the real interest rate was at its normal level of about 2%. You add them all up, you got a 7% 10-year bond yield. In 2020, we get a picture like this, right? The world's topsy-turvy. Nothing's behaving the way that it does historically. Expected inflation was about 1.8%. Okay, the term premium was negative. That was shown in that last graph. Again, makes no sense, but it was minus 0.4%. And then the real interest rate had also fallen to be negative, also making very little sense. Okay, but it resulted in an incredibly low, historically low 10-year yield, as low as 0.6%. Okay, then the economy has recovered from the pandemic. That's not 21. That's a horrible font. That says 2024. For a second, I went, oh, that's a typo, but it's not. Okay, and so the term premium is zero, right? We saw that, so we don't have the blue thing. Expected inflation we just saw was about 2.3%. Okay, that was the break-even inflation rate. And then the real interest rate was about 1.8%. Add them up, we get about 4.1%. So if interest rates are going up or down, it's because these components are going up or down. And the bad news is that's happening in unpredictable ways now, uncommon ways, and therefore unpredictable ways. And we don't really understand why. Okay, and that's pretty much a continued theme of what I was going to talk about today, because we are in a situation where our model is broken. I think we may have talked about this last time. Oh, question. Go ahead, Mark.
So it's been weird enough long enough that it's coming out of economics and rolling into finance. So like, what would you do? Do you do anything to a discounted cash flow kind of analysis when everything is so crazy now? Or do you just go with the way it's always been?
Well, I mean, it's all going to be a complete judgment call in these cases. And it's a matter of, to me, in all honesty, in my consulting work, it's what my audience is willing to accept. Right. And if I come in there with my cockamamie forecast and say, oh, the interest rates are going to go up and down because of these factors, they don't want to see it. And so it seems to me that when people do a discounted cash flow analysis, they keep it uncontroversial. Let's put it that way. I mean, interest rates go up and that ruins your discounted cash, and that's bad enough already, I guess. And so adding additional complication, I'm not sure I'm giving a great answer to your question, but in my world, that's the way it's happening.
A lot better that you're not giving a great answer, because there
isn't a good answer. That's right. Thank you for recognizing my weaknesses. So is the yield curve? I didn't mean it that way, but but it's true. It's absolutely true. So we've talked about the yield. The reason why I went into all that stuff is because it has to do with the slope of the yield curve. The yield curve is the curve that tells us the relationship between time to maturity and yield. So it just says, if you got a 90-day bond, your yield is typically low. Right? If you got a 1-year bond, your yield is a little bit higher than that, but still low. If you got a 2-year bond, a little bit higher than that. And the typical yield curve is upward sloping. Okay. And that's because the longer term bonds have to be paid extra compensation with higher yield. So the longer the yield curve just reflects that. Okay. The longer the maturity, the more, the higher the yield. And that's just a reflection of that term premium. Okay. The extra compensation. Okay. Every now and then, right, including now going back, I think almost 2 years now, the yield curve inverts, okay, and short-term rates become higher than long-term rates, and the yield curve, as we say, inverted, okay? For those of you that have been here before, did we bring this up before? Because let me show you the graph. This is the graph we would have seen. Never mind. So what's he talking about? So the yield curve shows the relationship between the maturity and the yield. It's normally upward sloping. That is the stylized fact we're interested in right now. Okay. We have theories of the term structure. As I was saying before, long-term interest rates are an average of the short-term interest rates expected to prevail over that horizon. plus additional compensation for the longer maturities. Then that compensation goes up the longer the maturity is typically. Okay. And so here's the yield curve as of what's today, the 25th? I don't even know. As of just a few days ago. Okay. And so it's downward sloping. I mean, it's got this little kink right here that, it doesn't really have any good explanation at all. But it's still considered a downward sloping yield curve, right? This is the real yield curve. This is the yield curve for those tips I was telling you about, the Treasury inflation protected securities. So this is the real interest rate, whereas this is the nominal interest rate here. Okay, but this is the one everybody's looking at. The fact that the real yield curve is pretty much upward sloping is pretty good news these days. But over here, we've got a downward sloping yield curve. Why do we care? Okay, I'm going to skip over the technical parts of this because they're going to go too far. Okay, where am I now? So here is the punchline and what everybody focuses on when we talk about the yield curve. This series here summarizes the slope of the yield curve. It's the 10-year yield minus the 2-year yield. Okay, so that gives you a summary. If it's upward sloping, it's positive. If it's inverted, then the slope goes negative. Okay, you can also do this with the 90-day treasury. It's really common to see this graph drawn that way as well. And you get pretty much the same pattern. Okay, so all of these periods where this goes negative, the slope is negative, it's the inverted yield curve. And notice what happens after that. It's been a consistent predictor of recessions going back even further than this. If you can get data going back further, it will predict earlier recessions as well. So look at this. This is where we are right now. And look how long we've been inverted. Okay, it's been a longer inversion than any of these other ones. Now, this is all the Volcker early 80s stuff. There's all kinds of turmoil in interest rates in financial markets right here that we don't need to really worried about, but it did result in a inverted yield curve, right? And so this is what, I mean, this thing started to invert, as you can see, right at late 2021, early 2022. And everybody immediately said, okay, here comes the recession. It's been a reliable predictor year after year of recessions. And then we went another month and another month and another month and another month. And it just kept getting more and more and more inverted. And we never saw a recession. And now it's started to get flattened again, and it will eventually be upward sloping, as it is something like 95% of the time in reality. Okay, but the other thing that I want you to notice, okay, first of all, it didn't predict the pandemic. That's ridiculous. Okay, I should have said that at the very beginning. But if you remember, thinking back before the pandemic, the economy was slowing already, and there were economists predicting that we were headed for a recession. We forget that now because the pandemic interrupted that period, but it could have been leading to a recession here as well. So but the other thing I want you to notice that nobody ever points out is, look at these recessions. We don't go into a recession until after the yield curve retains its positive slope again. The yield curve has to recover first, then the recession comes. We're not there yet. Okay, now, does it have to happen the same way? Of course not. This is human behavior we're talking about. It's not perfectly predictable. Yeah.
Behind the recession after the inverted yield curve?
No.
Just observation.
I mean, well, they know that. There's certain aspects of all of this that indicate a recession is coming anyway. Typically, we knew the yield curve would invert when inflation starts, the yield curve is normally sloped, then the Fed interest rates, and this side of the yield curve starts to shift up. The long end doesn't shift up as much, and so you always wind up eventually with that inverted yield curve, which says it's the Fed causing the recessions. Okay, we don't really have that phenomenon going on anymore because the Fed is backing off now. I mean, they haven't backed off too much on setting the federal funds rate, but they've told us that they're going to cut it 3 times over the next year if they follow through on that. Right. And they're also reducing the size of the Fed balance sheet, which is a part of the emergency monetary policy that they implemented that is intended to bring long-term interest rates down. Okay, so they're having that effect. And so there's nothing, to further answer your question, Larry, there's nothing there that says because the yield curve is inverted, we have to have a recession. The two things are just associated with each other. And there are economic forces that you can point to that make sense about that, but it's not causal. Okay. Okay. So one of the things one of the more controversial things that people like to talk about when I get into these types of sessions, and something that's come up all the time, is, are we going broke? Okay. We hear this all the time. We're going bankrupt as a country. Somehow the richest large industrialized nation in the world is going to go broke. It's something that when you compare us to other countries, we're not really even close in many respects. So let me ask one thing. This is a question that I've been asking. I've been teaching in the MBA program at UT for 10 years. The answer to this question has largely changed when I throw it out to the class over the course of those 10 years. Who thinks that we're overtaxed in the United States? Go ahead. Yeah, go ahead. It's okay. Hey, it's a perfectly legitimate thing to say, and it might be based on, you favor small government, right? And that's a perfectly legitimate argument to be making, and a perfectly legitimate ideology. And if you want smaller government, less regulation, then taxes can be lower than they are today. But if we phrase that question as how much are we taxed? Are we overtaxed relative to our peers? Then we can look at this diagram. This is the tax to GDP ratio for the OECD. OECD is the 44 largest market economies in the world. So there's no India here, there's no China here. Okay, but all the other European countries are here, Asian developed countries. It even goes down to countries that we would consider somewhat more emerging, like Chile, Colombia, and Mexico down here. Okay.
All right, Karen, go ahead.
Oh, I'm sorry. I didn't have anything to add. Yes, I do agree. I do think we are overtaxed. Maybe not in comparison to our peers, but definitely federally in comparison to what a lot of people make. It just feels like the IRS or your federal taxes hit you a little bit harder, at least on the county level. Ad valorem, you can see where your tax money goes, specifically schools, trash, etc. But federally, it does feel like we are taxed a bit harsher than many of us would like.
Okay, I can show you where the money goes. That's available. That's available. I mean, as Paul Krugman frequently says, the federal government of the United States is an insurance company with a military. And that's about accurate, because where the spending goes is to Social Security and Medicare. That's the insurance company, and then to the defense industry after that. That's the vast bulk of it. Okay, and so here we are, all the way down here, right? Lower tax to GDP ratio than any country that we would consider our peers. The only countries that are below us are these emerging economies that have less of a tax base, right? They have a much larger informal economy. So, there's no real sense by international standards that we can, look at Denmark over here, right? Americans look at that and they think that must be some kind of a socialist nightmare, right? As like 47% of GDP comes in tax revenue, but it's a different way of organizing their society, right? That's the question that I have is that that's not a percentage of GDP. Where's the health of the economy or the growth of those economies, right? Because Europe looks like it's a basket case, demographics, and a lot worse than we are. So, how do you balance the health? Yeah, I don't know if I would necessarily agree with that. If you're typical middle-class American, your living standards are pretty much the same as a middle-class European. We have a lot more rich people. That's what brings our GDP and our average income level up, right? So, but I agree with you. I'm not saying that this is good, bad, ugly, whatever. It's just the truth. And I think the truth is at least something that we should know before, and that way we can have much more informed ideological opinions, right? So here's the OECD average over here. We're well below that. So Mexico, it's only probably 70% of the economy is part of the formal tax base, right? It's natural that their tax to GDP ratio would be lower than. Okay, here's the U.S. federal government deficit going back in time. Okay, and I've labeled some of over here, nothing really happens. This is the whole Eisenhower tree. It's kind of boring, so I didn't label all of those. But you get the New Deal. This goes all the way back to the 30s. Okay, and so you get the New Deal spending, World War II, right? And then we get this period of the 1950s and into the early 60s. And then, of course, Nixon and Ford, right? You get this 1970s and things start to change. Okay, and so Nixon and Ford, Carter here, Reagan and Bush. It's well known that Reagan financed this big defense buildup and cut taxes at the same time. That's going to make the deficit go up, and it did. Then we get to the Clinton administration. The 90s are pretty much considered the Goldilocks economy, right? The economy was growing not too hot, not too slow. It was the longest peacetime expansion that we'd ever had. The budget went into surplus for 4 years, right? Which hadn't happened, except in, these little blips all the way here. And then George W. Bush gets into power. He says, we got a surplus. That's your money. And he gave it back to us. I don't know if you remember that. We got checks, right? There's the first time we got direct payments. And then I got W here, Obama, and this is all the stimulus associated with the Great Recession, of course, but that deficit goes way down as a fraction of GDP. And then here's the Trump administration. Of course, we get the pandemic, right? And any government was going to spend to overcome the pandemic. Whether they were going to do as much as they did is an open question, but any government was going to respond that way. So you can see where the deficits sort of increased and decreased over time, right? And this is the fiscal space. This is one of my favorite diagrams to show my classes because it gets some of them angry. And that's not my intent. Again, it's just to give the, basic facts, right? And so this is the change in the deficit to GDP ratio from the beginning to the end of the presidential term. Okay, so what it says is whatever you entered with, the deficit to GDP ratio that you got, right? How did that change over the course of your administration? Okay, and you'll notice, contrary to what everybody believes, and I think this is probably political strategy, right? Those things there's less fiscal space for their successors left behind by the Republicans. Only the Kennedy-Johnson administration do you see a big blue bar here. Okay, it's the Republican administrations that are increasing the deficit to GDP ratio over time, not the Republican ones. The exact opposite of what everybody thinks. Okay, look at Obama. Right? It's basically this was massive $737 billion spent on the American Recovery and Reinvestment Act, what we called the Obama stimulus, and it drove up the deficit dramatically. But if you remember, think back to Obama. He was paranoid about being called a tax and spend liberal, right? And so he made sure that deficit, was eliminated by the time he left office, right? There was no difference in the deficit to GDP ratio from when he entered office to when he left. Okay, now this is just, we can't saddle the Trump administration with the pandemic spending, right? Anybody was going to do that. As I said, we did include Obama, right, with the Great Recession spending because it was just the deficit effects of that were eliminated before he left office. Okay, so here is U.S. federal government debt to GDP and its projection over time. And we look at this graph and we go, what in the world? We're going to take over the whole economy with this stuff. We already have. So we're talking about by 2053, debt to GDP ratio. This is debt now. Total treasuries outstanding as a fraction of GDP. Every time the government runs a deficit, they got to borrow by issuing treasury securities. Okay, this is how many of them there are out there now. Okay, and how they're projected to grow. So this forecast isn't exactly current. As you can see, we can't get a more recent one than this because this comes from the Congressional Budget Office. They haven't updated it yet. Then until I think we figure out exactly how much spending we're going to be doing over the next several years, when Congress can actually pass a budget, then they can update these. But that's rare. Okay, so that doesn't look good though, right? I mean, that looks kind of bad. So the question comes up, how high can it go? And this is a question that economists have been interested in for an awful long time. I'm sorry about the quality of this graph. It's just because I wanted to get as many countries on it as possible, because people have questions sometimes about all this, but we're all the way over here now. This is our debt to GDP ratio compared to all these other countries of the world. I mean, Greece is the number one, and then comes Japan. I mean, I'm not sure many people know that Japan has been fighting deflation since the 1990s, and they have implemented all sorts of emergency monetary and fiscal policies to help them get there. And the idea that they've got their debt to GDP ratio up to 220% of GDP, there are commentators who would say they're a basket case. They're not a basket case at all, right? They're a very high functioning economy with very high living standards. Okay. And so, but some of these are kind of interesting. I mean, look at Russia. Russia's got a very low debt to GDP ratio. There's a couple of very good reasons for that. A, nobody wants to lend money to them. And B, even if you do, they get their bonds get subject to international sanction. So they're very careful not to do things that are going to be subject to sanction. Okay. But you can see all these other countries on there too. And so, is it sustainable? Okay, that's the question I wanted to answer, and I've only got a few minutes to do it. Right? The debt to GDP ratio has grown substantially in the U.S. economy, and people are very worried about it. And how worried about it should we be is the question. And I don't have a good answer to that. I don't think anybody does. But we do have, we can put some structure to the whole idea of what causes it and whether it's going to become dangerous or not. Okay, and the way that we do that, forget all the words on the slide. So long, here we go. This is the rule, and I'll have to read it and then explain it because it's written in economics. So so long as the growth rate of nominal GDP exceeds the interest rate paid on outstanding government debt, that's Treasury securities, by a sufficient amount, then government debt is sustainable, meaning it's not going to blow up to infinity. It's going to converge on something finite, which means it's not going to be a crisis. Okay. And so the growth nominal GDP is a measure of all production in the economy. It's a measure of all income in society as well. All compensation for labor, capital, anything else, intellectual property development, et cetera. It can be GDP can be interpreted as a measure of income. Okay, for the whole economy. So that's the tax base. Okay, that's the tax base that you're drawing from, right? And so long as that grows, the tax base grows at a rate faster than you're having to pay interest on your debt. Okay, if you're generating more than enough revenue from taxation to pay your interest and then some of your other obligations, then your debt to GDP ratio will not grow without bound. It'll converge on something finite. Maybe that'll be high, maybe that'll be low. We haven't answered that question here, but we know that it's a sustainable policy. This is a point that's been made a lot more strongly by economists just in recent years, including that same character, Olivier Blanchard, I was talking about lately. His whole, I can't remember what speech it was that he gave, but he was the chief economist at the IMF for a while, and it may have been when he was there. And he gave a whole speech about how if this condition for sustainability is being satisfied almost all over the world. And so here's us. His point was, it was during the pandemic, and his point was, don't worry about spending money now. It's going to be you need to spend the money now to keep your economies afloat, right? You're not going to it's not going to lead to an explosive growth in your debt to GDP ratio, and therefore what we would call a sovereign debt crisis, so long as this so long as the red line is, I got them backwards, don't I? So long as, yep, I got them backwards. Sorry. This is supposed to say nominal GDP growth in red and 10-year yield. I apologize. That's a horrible mistake. If my students were here, they'd be ragging on me big time. Yeah, thank you. I deserve that. And so you can see, except in the 80s when the deficit blew up like we saw, right? It was partially because the the world was working against the Reagan administration at that time. The pattern was the reverse from what it should be. Interest obligations were a big burden at that time because nominal GDP growth, the tax base was growing at a slower rate. So over here, right, this is what Olivier Blanchard was talking about. What are we worried about? Right? Go ahead and spend the money now. You worry about the consequences aren't going to be that bad. You need to do it now. And this is telling you it's not going to generate a crisis. It's going to be easier to deal with it later and get it back down again when you're back on a sustainable trajectory. Okay, go ahead. Sorry.
How much of GDP growth would you say is due to population growth?
Not very much, not in the United States, because our population isn't growing very fast. And in Europe, it's going to be a drag because their populations are growing at negative rates, as is Japan and things like that. So not much.
So you don't think a flat population would contribute to slowed GDP?
Well, it won't contribute to the growth of GDP. Sorry, population does make GDP grow up, population growth. But if you don't have population growth, then there's no impetus from that whatsoever.
Okay, so this past we've had a lot of population growth in the United States, and we are starting to slow on there. So do you think that would have an impact on this?
Yeah, we don't really think. Most economists are not going to think that that's a material effect on
Okay.
GDP. It's more about productivity
Oh, okay.
and making sure people are buying things. Sure, population influences, but it's such a small level that we don't really pay much attention to that. It's a good point, though. That's
Okay.
why we look at GDP
Yeah, I
per
thought-
capita.
Yeah.
We could do this with GDP per capita. I don't think the result would look any different. Okay. But that's a good question. I appreciate the question. Nobody ever asks me questions like that. And what about population growth, Sadler? Okay, that's a good question. I know this one got a little bit more technical than it did, so I didn't know what else to talk about, right? And I skipped some of the most technical parts, thankfully.
You talked about efficiencies, and I guess I got two questions
Mhm.
for you. One is, when you look at the debt in the economy, you've heard about recent EFTs being approved, and do you think the U.S. government will ever go to a digital currency, and what are your thoughts around that?
I think it's a big problem. My thoughts, I don't know if they're fully formulated yet. I think from an efficiency perspective, it's a no-brainer, but it has such severe privacy concerns right now that I think most Americans are uncomfortable with it for that reason. There are different ways of doing it, and the easiest and most, I guess, the original idea on how to do it was we would all have our own bank accounts at the Fed, and our digital currency would all be stored there. Well, that bypasses the banking industry, and the banking industry in the United States is very large and very powerful, and they're upset about that, and so they're working on trying to develop a system where the banks are included. And I think that's what we're going to have to do in the United States if we're going to do something like this. I don't know for sure. I'm not an expert, but that's my take on the whole thing. Now, China's already got one, and they're already using it, and they really want that to take over for the dollar. That's one of their strategies, to have the renminbi accepted as a global currency. Am I out of time? Oh, okay. Okay.
Here's a question about the inverted yield curve.
Yeah.
It's always been talked about the predictive nature, but is there any discussion or discourse about the possibility that it's a causal? Like this discussion kind of, really puts negative doubt into the future of the economy, if there is an effect like that.
Oh, yeah. As far as consumer confidence and business confidence, it may affect that. That's true. But that's an indirect, that's not causal. It's going through something else then. But you're right. I mean, I look at that and I think, because I've been around long enough to know that the inverted yield curve means bad things. I think, geez, I better sell some stocks, put some stuff into some safe assets or something like that. That has an impact. If everybody in the economy is doing it, it certainly has an impact. So yes, I think there's something to that, as well as all the pessimism that we heard about the economy going back a year or more. And even to this day, I mean, when you ask typical people, I mean, notwithstanding that thing I told you about workers before, when you tell people now, when you ask people now, what do you think about the other? They'll say, oh, it's terrible, right? It's because their prices have gone up, and it's understandable to a certain extent. But yeah, I think there's something to that, but not beyond that. I think beyond that, it's a reflection of the same thing is causing both the recession and the inverted yield curve.
We have a Zoom question from Karen. Karen, you can go ahead.
Thanks. So in the news, maybe about a couple months ago, there was a lot of talk about China, South Africa, a couple of other countries. I think it was 4 countries that are going to make the decision or have made the decision to not use the US dollar in trade. And everyone was nervous, and there was a lot of talk about it, and then it just kind of died off. Is there any potential concern for that for our country in the future?
Don't believe so. Those were the BRICS: Brazil, Russia, India, China, and the S was originally South Africa. I'm not sure they're included in that anymore. Even the guy who coined that term said, this is one of the dumbest things I've ever heard. So it's in order to get your currency accepted as an actual global reserve currency, it takes a lot. And they're trying to create the critical mass necessary for that to happen with some other currency. Which one it's going to be, I don't know, but I assume it's going to be the renminbi. And if they can get trade flows being paid for in that currency, then it generates a demand for the currency that may be self-sustaining. I mean, that's the one reason why the dollar has the advantage that it does, is that it's used for international transactions all over the world. If you're buying crude oil, you have to use dollars. If you're buying most commodities, it has to be in dollars. That creates demand for dollars independent of anything else going on. And so that's what gives a currency its value, is that people actually want to use it. If they're able to create a critical mass in the BRICS with their new monetary arrangement, then maybe they'll start to, take over probably more of the euro, I would think, in the international world than the dollar. But I don't think this has been tried before, and it never gains any traction because nobody really trusts the Chinese Monetary Authority. Let's just come right out and say it. Right? It's like, I'm not going to let that be the global currency of the world and make the world dependent on Chinese monetary policy. Right now, the world is dependent on Fed monetary policy. They have a reputation for being credible and for not doing extreme things, which you can't say about the People's Bank of China. So I don't think it's much to worry about. And I've seen this before. I've been around long enough now to have seen these types of exercises tried before. Now, China's a growing presence in world trade, as is India. And if it gets to the point where they can convince other people in the world that, hey, we're going to trade using this currency instead of dollars, but good luck. Okay. It's so embedded. This is like, if you ever read Malcolm Gladwell's Tipping Point, they've got to reach the tipping point. There's a benefit, an efficiency benefit to having one currency be the dominant currency for international transactions. And until they can displace the dollar, they aren't really a candidate to provide that role. Yeah, go ahead.
So back to your slide on the tax revenue,
Sure, my pleasure.
Tax revenue relative to the GDP, by country. Yeah. So US scored, fairly low, which is a great thing. It seemed like the rate is lower than most of the peers. My question is, I can't see those notes on the bottom, too small for me.
Oh,
but that data for the tax revenue, how comprehensive it is for each particular country.
How say that again? I'm sorry.
The tax revenue data, all the numbers that they get, how comprehensive it is for each particular country.
Oh, it's coming from the governments.
No.
OECD is collecting it from the governments themselves.
Okay, so the government, let's say the US number, does that include the revenues from the federal income tax, the revenues
all taxation, state, local, and federal, corporate, all taxation divided by GDP, all tax revenue.
And I
should have said that. That's a great question.
And that's true for every country. They actually
That's correct.
have the expertise to understand. Okay.
That's correct. Mhm.
Okay.
The
Thank you.
OECD is pretty good at this stuff. Like, and they've been around a long time.
Yeah, just a quick question. On one of your slides, you had, you talked about some of the troubles in the banking sector.
Yeah.
And you specifically mentioned commercial real estate.
Correct.
So we had some bank failures
Yes.
early last year. And I don't know a lot of the specifics, but aren't there some requirements coming up in March, whether that's either repaying those payments or something to do with collateral? And if so, do you foresee any problems in the banking sector coming up here shortly?
Well, yeah, and I think what you're talking about is, I can't remember the acronym, but in order to deal with the emergency, the Fed allowed banks to borrow from a new facility at face value instead of market value. So as the market value fell, as interest rates went up, that should be the collateral, right? Is the lower value of that, and they were loaning it to them, they're loaning the money to them at par. That's what's going to disappear. I think that's what you're talking. That's what disappears in March. That's a subsidy to banks that's going to just disappear into thin air. That could cause problems. How we don't to understand the sensitivity of something like that for individual banks is extremely difficult, right? But it's going to involve stress for some banks. Whether it's going to, have an impact on the overall banking sector, I don't think the Fed would be doing it the way they're doing it if they believe that was going to happen. But combined with other things, they may be wrong, right? Sure. Mhm.
One item you didn't talk about, but productivity, just your thoughts on AI, and will it be
That's a good question.
productive issue or a negative on the economy?
Well, you're the first person that's actually asked the second part of that question to me. My MBA students all think it's going to be the best thing since sliced bread. It's going to save the world. Because we talk about, I told them how we measure labor productivity, and they say, oh, well, that's going to be doing one of these in a few years because of AI. And then was it The Economist or something I was reading about a week ago? And the title of the article is, "What Happened to the AI Boom?" Right? Like, is it like it's dead already or something? I don't think that there's been enough time for it to really work its way into the system. But I have to punt on that. I don't know. I don't understand it. I'm retiring from teaching now partially because of this. I don't know how to deal with it. I mean, we get all these people, like the people who are really computer savvy, sending us these emails at the faculty at UT saying, don't be intimidated by it. You can use it to help your teaching. And it's like, yeah, sure. Right. Like, well, I'm going to learn how to code and drive an AI thing now somehow. So, the fact that it's possible for students to cheat on things now without me knowing it, using that, scares me. Right. And I think that's a negative, right? If it means that we don't think for ourselves anymore, but I don't understand the extent of whether that's true. Maybe it's going to maybe it's complementary. Maybe it's complementary to our own human capabilities, and maybe it will enhance our productivity then. I honestly don't know. I wish I could give you a better answer to that. And I don't think nobody, there's no real consensus on it so far. And I wish I could do better. Go ahead. Yeah.
All right, go ahead, Anthony.
Looking at the size and magnitude of the commercial real estate market, where we're seeing
Anthony, can you start over?
leases. Okay, I'm saying, looking at the size and magnitude of the real estate market, we're looking right now, I would say Class A office space is just keeping her own, nice and steady at the moment.
Yeah.
But more than 50% of all leases, according to CoStar, are set to expire within the next 5 years in total. We're also looking at 1.5 trillion of debt being refinanced or coming up for maturity in the next year. Those are big markers right now. You're also looking at Brookfield, who walked away from 2 flagship properties in Los Angeles. Can we see the perfect storm, like really building right now, that can impact the economy just from that one sector?
Well, it's only part of that sector that's doing it. Again, this is something that I've read. not something that I have any of my own personal expertise in. The actual office space in question is, I can't remember what percentage of the commercial real estate market, but it's not huge. And there are all these other things associated with what we call commercial real estate, like malls and shopping centers and whatever else is in that group, that are doing well and are doing fine. And so the commentary that I've been reading says that, yeah, you're going to have a crisis in Class A office space and maybe below that, but it's not going to be enough to bring down the whole commercial real estate sector, and therefore not enough to bring down the banking system. Individual banks, you know, if their exposure's in the wrong place, yeah, and hopefully there won't be too much contagion from there. Now, again, this is something that I'm reading somewhere else, and that's about the best I can tell you right now. But that's what the take is of some economists that I respect anyway. Okay.
Okay, thank you.
You're welcome. 5 o'clock. Okay. Thank you very much, everybody. I appreciate it.